All right, so talking about the bull and the bear. This is back to the ratios. Back to the as-is valuation price. So this is where we left off on Monday with Coke with the as-is. So based on what you've been working on, somebody give me your bull scenario for Coke. Who wants to share? Practice sharing. They've been talking for 20 minutes, so. Start out with some assumptions. Growth assumptions, margin, tax rate. G, what'd you put in for your bull? Yep.
So I think the biggest thing I changed was
We'll start with the numbers first,
uh,
so I can actually replicate what you did up here.
so I did a revenue growth of 2%.
Okay.
I left the tax rate. I probably put margins down to around like 35%.
In the bull. This is the bull.
Oh no, sorry, the bull. Yeah, sorry. No, then I kept margins around the same. The only thing I really changed was revenue.
All right. And that gave you like a $44 stock price?
Yeah.
Okay. And you think that's the optimistic scenario?
I do, yeah.
Okay. All right. So now let's talk about why do you think that's the optimistic scenario? What are your rationale behind it?
The big thing was they're pushing more of like the no calorie, like low calorie products to combat like the big decrease in demand for the sugary products. The only problem was I don't think it's going to do that much to revenue growth, just because they still are like very weak in emerging markets, which is where all the big growth potential is, and there hasn't been any signs of increasing demand in like the U.S. really, because of like that a lot of regulations with the sugary products.
Okay. That's what I've read. All right, but if we give them the benefit of an optimistic scenario, I think I remember reading in one of the industry or company primers, it talked about how the core kind of soda business is dropping like 5% a year. Does that ever sound familiar to everybody? So that would be the point, is that in that context, 2% growth is optimistic, right? So what you're saying is, here's a company that's seeing its core business shrink, and if the fact is they can stop the shrinking and get to positive growth, then that would be a little bit more of an optimistic scenario. The only thing that could have made it a little bit more optimistic is if you felt that their cost cutting got them even better margins, which might get a little bit higher stock price. But that would be the point about the catalysts. Okay, and so what you're really saying is they're not. If I can repeat back to you what you said, Coke 2% is really more of the bull scenario because they're dropping 5 right now. So given the restructuring, we think that could stem the declines. They can get some growth. Emerging markets could help them, but right now they don't really have the right products in those emerging markets, and sugar still remains a problem. So that's going to give headwinds. But if they can get to the 2% with the margin cuts, this could be the upside. And with this upside, they were already at kind of the top end multiples. So to be honest with you, this upside and keeping the multiples at this level is still pretty strong. Okay, so that would be the other part of Coke, is that they're already kind of priced near the upside of the range. So what you're saying is the bull is not too far above, staying where they are, and there's probably more downward pressure.
And I felt like if I were to change, like increase their margin, things like that, the multiples just start to come like too out of line.
Yeah. So to some degree, they're kind of near the peak, and there's probably more downside risk. Right? So again, what matters more is not whether you said 2%, 2.5%, or 3%. What matters more is the linkages to why it's 2% and some of the underlying thought. And again, some of this is art and it involves some practice, but this is what we want to continue to practice as we work through our group projects. And he also made some other assumptions without saying it, meaning he didn't change the tax rate. So he basically is assuming a stable tax structure for Coke going forward. He also made another assumption about margins, that they'll maintain high margins. They won't lose some of the margin gains that they're expected to get over time. Well, that is part of a bull scenario, is that they won't be hit with competition. There was an article in the Wall Street Journal today that talked about the demise of Whole Foods. Is that Whole Foods has had something like 12 consecutive quarters of same-store sales declines because they invented the market, but now they're behind, and the biggest organic supplier in the U.S. is now Costco and Kroger. So the traditional grocery stores, Costco, Kroger, and now Walmart, are now beating Whole Foods at its own game. And basically, their suppliers are now going, that's what the Wall Street Journal said, they're actually going away from Whole Foods. They're going directly to these other companies because they see them as bigger market opportunities. And suddenly, the company that invented the market is really struggling. And I think to some degree, Coke is seeing some parallels with this, is that, they are a company that invented this kind of core soda selling sugar water market. The problem is that the markets around it that they don't really dominate are the ones that are starting to do relatively well. The low calorie drinks, the water alternatives, to some degree even the energy drinks. They don't dominate those markets, and they're in a transition while they try and figure this stuff out. So that's where Coke is having some challenges. So even on the bull side, given those challenges, the upside doesn't seem too high, is what he's really saying. All right, what about the bear side? Who did a bear scenario? So I'll say this is the bull. File, save as bull. Who did a bear? Somebody different. A little bit more pessimistic scenario for Coke. What are some of the things that could go wrong, and what are some of the ratios that you represented in the go wrong scenario? Another team. Are you stretching, or is that a hand raised? Yeah, just stretching. Close. How about the group of three right there? What did you put in your bear scenario?
So
Start out with the revenue growth. Let's get some numbers in here.
yeah, so in revenue growth, we put -2%.
Okay.
We kept EBITDA the same.
Okay.
In our bear, in our bull, we also actually decreased the tax rate to 20%.
Okay, I'm looking at the bear now. Forget the bull for now, just the bear.
So we did it for the bear as well. Though.
Okay, so the tax rate 20?
Yeah.
So you actually think the tax rate will get better?
Yeah.
Okay. Okay, and?
And then we decreased the CBG to 2%.
All right, which got you down to like a $32 stock price? All right. So, again, what would you say were some of the catalysts that led you to make those changes?
So for the tax rate especially, we decreased the tax rate because they are getting rid of a lot of their assets and they're selling a lot of stuff. So that should decrease the tax rate, which it has done in 2016 also. You can see the tax rate was 19.5 in 2016 also. That's why we adjusted that.
There's also, because of those divestitures, was kind of one of the rationales as to why the margins might stay reasonably constant, but the revenue growth itself might decline.
Okay. So what else could be a headwind to their revenue growth? Because you're really dropping, and not just for the next 4 years, if you're dropping your CVG, you're kind of assuming tough challenges longer term as well. So what are some of the problems that they might have with revenue growth? And anybody else can help them with this that you might have even read as you went through the BICO. What were some of the things that came up? Or the team can mention them as well.
Like, I saw an increase of government regulation on like those high sugar drinks, like increased costs due to.
All right, regulation. There was a specific reference to something happening in the U.S. in 2018.
They have to put the wrapping on the label. They have to put how much sugar is in it, how much sugar is added.
Yeah, they're basically going to have to put warning labels on the drinks to say this drink is bad for you and here's how much sugar you're actually drinking, which could actually really hurt and even further hurt consumer protection or consumers' perception of the soda. And I mean, it's no different than when the cigarette companies were first forced to put, warning this is going to kill you, and they didn't want to do it. And obviously, cigarette sales declined after that. I think Coke might see further declines if they're being forced to put these warning labels on their product. And that could be a big negative catalyst for them, particularly in 2018. So there's one. What else could really hurt Coke? Yeah, that they see that continued decline of revenue from volume drops. Like this might actually be not as bad as it could be, and what's causing that decline is competitive pressure. Might actually have to start lowering their price, which could further hurt them. Yeah, what else? So some commodity inputs could impact them. And so even the cost of the cans themselves, the bottles that they're putting together could be higher and therefore could impact their margins. So absolutely, that's probably more the bottlers would be hit than Coke, but nonetheless, as they deal with the overall selling strategy of what they do with their price, that could affect them and the margins they're able to pass along. So commodities could impact them. What else? I'm thinking of another C word. There's commodities, and then there's... I'm sorry? Well, there's a third C. So you got a good second C is how much competition, and could there be more intense competition? Currency. Why might currency impact Coke? They get a lot of international exposure. And what could hurt them with that international exposure? That's right. They've probably been benefiting by the appreciating dollar. Well, what happens if the dollar starts going in the other direction? Right? And when they have to convert those foreign earnings back to US dollars, then they're going to be worth less. So from a Coke standpoint, that could eventually hurt Coke. Okay? So essentially which direction the currencies are going and whether or not that is benefited or hurting their earnings, and the headwinds associated with that or tailwinds could benefit them. So that could go into the share price scenario as well. So again, to be honest with you, this is not, the big one is not the next couple of years. The big one's that long-term G, right? And so to articulate that, what are you really saying about that long-term G when you go from 3 to 2%? Like, just translate that. What does that really mean? So what you're saying is, but they're going to underperform long-term in the growth. Why? Why might they underperform long-term? Not just the next few years, but long-term. Why might they underperform? I'm sorry? Okay, but the factors we listed, we're talking about kind of in the next 2 or 3 years. So what you're saying is nothing's going to change longer term structurally, and Coke is not going to overcome this. Right? So it's not like they're going to suddenly find new adjacent markets to get into and suddenly turn them into growth trajectories. That Coke is really structurally going to struggle longer term as well as short term. Because that's the point, is that when you lower their long-term G, 1% compounded every year, that's actually a pretty substantial amount of slowing growth. And now you're actually saying that instead of growing with the economies, they're probably growing a little slower than the economies long term. What's the rationale? So intuitively, I know it's kind of in here in your head, and it makes sense to you to do it. We got to articulate that out as an assumption, particularly in the bear case. Okay, so even if it's saying, hey, I think these problems are being stretched out into the longer term, and this is why, then that's important to say. And that's the practice that we want to get. Okay, and oh, by the way, if I look at the multiples associated with a $32 stock price, let's go back to the multiples page. These are actually much closer to industry average. So basically what you're really saying in your bear scenario is that Coke starts looking like everybody else, right? So is that achievable? Absolutely. because those are the multiples of the industry. So really what you're saying is Coke is going to lose its premium in the bear scenario for those reasons, right? Where the bull scenario for Coke is they maintain their premium in a difficult environment at a very high level. And that's the difference between your articulated bull and the bear. Now remember, the bull is what you think in the next 12 months is the better scenario. The bear is the worst scenario, and you're kind of giving a 12-month, high and low for what the stock price can be, right? And then you're going to decide in your target stock price where you think they're going to end up along that range, okay? Now, again, when you did the bull, I think you think that that's probably realistically where Coke is going to end up. All right, so you could actually be closer to the bull scenario, and that's okay. So maybe you're in the hold range, which for you is what you actually consider to be a good scenario for Coke, right? Versus the bear, if you really believe that they're actually going to have those problems, then they could be towards the bear range, and that could be closer to your target stock price, or you could be somewhere in the middle. So again, then you would do your target and you would explain it. But what I want you to do is I want you to explain it around our 4 assumptions. What does it do for growth? What does it do for the long-term G? What does it do for the margins? What does it do for the tax rate? By the way, the one thing you didn't talk about is that the CFO for Coke said 24% on Monday. The VP of Investor Relations said 26%. You're giving them a benefit with the lower taxes. Coke actually said the taxes could get worse. So in the bear scenario, if we use their 26% tax rate, then the head of investor relations said they'd start paying in 2018. Ratios 26. So there's 26 there. Then the share price gets even lower to 30. So assuming we follow that scenario, we got 30 on the low end, we got 44 on the high end. There's our trading range. Where do we think it's going to end up for these reasons? Questions about what we just did? Okay, so what I want you to do for Monday's assignment, individual assignment for all sections, some people are visiting from other sections, is basically I want you to do the same thing for Nokia. Okay, Nokia, which used to make handsets, big cell phone retail provider, well, they're out of that business anymore. They don't actually make cell phones anymore. They actually license their brand to a Chinese knockoff company, and there's a Chinese knockoff company using their brands to sell Android phones. That's not Nokia anymore. So Nokia is no longer in the business of manufacturing handsets. What they did after they got out of the handset business is they bought Alcatel-Lucent and they bought Bell Labs. And now they're in the network services provider, and so they now sell the equipment to the telecommunications industry. So instead of selling the handsets, they're now the providers of the equipment to the back-end telcos. Okay, so their competitors are going to be companies like Ericsson, Huawei in China, which is private, unfortunately, but Motorola, ZTE, companies like that. So basically, they're the ones that are now selling the back-end systems. And what I want you to do is an as-is, a bull, a bear, and a target. So 4 Excel files for Nokia for Monday. Now, when we do Nokia, they're a Finnish company. So make sure you do in euros. So Nokia FH equity. Don't do US equity. Don't do the ADR. So we don't have that Anheuser-Busch problem that we had before. All right, so make sure you do it on Nokia FH equity. And you'll see they're trading at about 5 euros. In fact, if you really want to see a painful problem for that company, their share price before Apple showed up was at 50 euros. And then Apple showed up and they're at 5 euros. Okay, so they've had a pretty painful decline from the early market where they pretty much invented the cell phones that we buy. They had the original candy bar phone that everybody has. And now they don't even make the phones anymore. Now they're selling equipment and trying to figure out what's next. Now there's a potential catalyst that's coming in this industry, which is 5G. Okay, and 5G is the next wave of high-speed data. And that's supposed to get here around 2020 plus or minus. But basically, Nokia would be selling the back-end equipment along with their competitors to companies like AT&T and Verizon Wireless and T-Mobile, etc., that are basically driving out these networks of the future. So how well they do is probably going to be part of what we're going to have to talk about as part of our analysis and our analytics. Right? So That's basically your individual assignment for Monday. Okay, so you're going to turn in 5 files, right? 4 Excel files, as is, bull, bear, target. 5th file is a Word document, which is your write-up of the assumptions for all 4 around growth, G, EBITDA margin, and tax rate, and why you're changing them through each of the models. So practice. Okay, and by the way, this is probably the closest practice to what you're going to be doing for your group projects, which you're going to deliver in 3 weeks. So group projects are basically going to be due 3 weeks from today. So basically, this is going to be pretty much our final big dry run at this. Okay, so questions about Monday's assignment. That's the individual assignment for everybody. All right. In addition, we have 2 groups. Their final 2 group assignments that didn't present the group individual homeworks are also due on Monday. So basically, the first of the 2 groups, so who's in this section? We have 20, is it 20 and 21? Yes? Who's 20? Team 20. All right, so for Team 20, you can see this here. I posted an announcement on Elms, and then we'll get to the other assignment next. So, Team 20, you're going to do the Supertree, which we'll talk about in a second. And Team 21, you're going to do what I call the Enhanced EIC. So for Team 21, as part of your group assignment, what you're going to do is you're going to do an EIC. So you'll talk about the beta. Right? You'll talk about the on the industry spread, company spread for industry and competitive advantage. But I want you to do what I'll call the Enhanced EIC, which means talk about the real catalysts that are going on in this industry. And just like we started to do for Coke. So the people that are doing the individual assignment for Nokia probably going to do it relatively superficially. I want you guys to educate us much more because I think very few of us know anything about this industry. So we really need to start to understand what are some of the driving factors in this industry. So think of it as not just 5 forces, but a little bit more, again, as we talked about the catalyst for the bull and the bear, what could drive this. And I'll give you an example. So I just talked about one of them. So importance of 5G networks. How fast the carriers decide to upgrade. Like, do they stay with 4G for a while or do they jump to the 5G bandwagon? And what does it mean in terms of that for industry growth? Here's another one, which is companies like Amazon, Google, etc., which run data networks, are now selling essentially cloud-based data access. So does that displace, as they potentially get into this industry, like if I'm a carrier, do I need to buy my own equipment? Or do I go to Amazon Web Services and I just hook into the Amazon cloud? And Amazon essentially starts powering my back-end data. So is that an emerging threat to this industry? And is that going to change the dynamics of the competition of this industry so that what you might think of as non-traditional competitors might actually start showing up, right? So that's another dynamic that could affect this. As well as some of the global issues. I'll give you another global issue, which is Huawei has been cleaning up with low prices, right? But the one problem that Huawei has in the US and Europe is Huawei as a private company is run by people that used to work for the Chinese military. And that has a lot of fear right now in the US and Europe about whether or not they want a company that's controlled by ex-Chinese military building the back-end telecommunication infrastructure in the networks. So do we run into trade barriers? Do we run into other issues that could affect the growth in this industry? Right. So I'm just mentioning a couple catalysts, but those are the types of things that are real to the players in this industry. And we need to talk about those issues as it would affect these valuations. So that's what I really want as a little bit more detailed. So again, go through the IBIS World Report. It's going to be talking a lot about this. Go through the BICO. It's going to be talking a lot about this. Educate us as to what's really going on in the industry. Right? Now, you're going to be doing the assignment individually without the benefit of all of this knowledge. And so, but nonetheless, next week, we might pick another company and then go deeper into this industry on Monday. So whereas we do Nokia as a group, maybe we'll do like an Ericsson or a Motorola or somebody in class on Monday to kind of look at some peers. Okay? So that's our assignment for Monday. Clear on that? All right, here's the final thing I want to mention today. It's called the Supertree. So in the file section of Elms, there's a folder called ROIC Supertree, and in it are 2 PDF files. Okay, so this is going to be the other group. So this is group 20. We'll be doing the Supertree. 21 we'll be doing EIC. So here's what I mean by Supertree. If we're going to do financial analysis, right? Generally, if we look historically, we've been looking at one company. But ideally, financial analysis historically is almost like a T, which means we want to look across peers and we want to look back in time. So we want to look at trends over time, and we have to look at trends across the industry, hence the Supertree. So the idea is, instead of looking at just the ROIC, and I'm going to switch back to Coke for 5 years, right? We want to look at the ROIC for Coke and 5 other companies. So we get a better understanding of what I'll call an industry ROIC. Okay, so here's Coke, Monster, Pepsi, Dr. Pepper, Snapple. I forgot who Fizz and STZ are. I think one's National Beverage and the other is probably Constellation Brands. Right, and those are the 6 kind of peer bottling companies or beverage companies that I chose. And then we have 5 historical leaders for those 6 companies. So here's the point. At a very high level, this is a straight average. But how is Coke doing against the average of the industry? So what we see is Coke is improving its ROIC, while the average company is actually seeing a decline in its ROIC. Right? So that could be telling. Right? So again, is a company getting better, worse, or staying about the same of its peers? Maybe the industry is getting better and my company is doing worse. In this case, Coke is actually doing better as the industry is getting a little bit more challenged. Okay? What's driving the challenges? Well, and what's driving the betterment? Well, tax rate's one of them. For the industry, tax rate, you see it here, went from 28 to 29. It's kind of hurting the industry. At Coke, it went from 23 to 19.5. So Coke is actually benefiting right now by a lower tax rate, which might start to go up, but nonetheless, that is actually something that's helped them over the last few years, where the industry is actually paying a little bit of a higher tax rate. So nonetheless, identifying a trend so we know what's happening at the industry level. Pre-tax ROIC. Coke is actually getting a little bit better, industry getting a little bit worse. Why? Well, as we go to our margins, Coke's margins are falling. They went from 22% to 20.6%, where the industry went from 18.4 to 22.4. So again, same thing. Coke is actually having more challenging margins, while the industry is improving its margins. What's behind this? Second level of analysis. Coke has had pretty constant gross margins, but Coke is spending more in SG&A. So basically what's really hurting Coke on the margin side is they're spending a lot more SG&A relative to sales. Kind of makes sense. My guess is to combat the decline of people buying less of their soda, they're doing a lot of marketing. Can't turn on a TV without seeing a Coke commercial. Go to the movies, you see Coke commercials. Coke spends a lot on advertising and marketing. And that's the problem. They're spending on that to combat the declines and they're not offsetting the erosion in their sales, despite the advertising. And that's a challenge for Coke. So what are they going to do next? It's going to be part of our valuations, but that's not the trend we're seeing in the industry. In the industry, we're actually seeing the slightly different perspective. So again, how does that play out? Right? Then we go to productivity. Productivity in the industry is actually getting a little worse, 95 to 102. Where Coke, it's actually getting better from 97 to 81. And in fact, as they started, as you read about in BICO, the reorganization, where they're getting rid of their bottling assets, they're getting rid of their non-core assets, you can already see the gains in productivity by the asset reduction, right? Which is already starting to show up in their 2016 results. So nonetheless, that's a little bit different trend than what the rest of the industry is doing, so we'd identify that going through the drivers. So basically we go through the tree, except now we're going through the tree on the company and the industry and the company against the industry. That's what I mean by doing a super tree analysis. That's the assignment for the other group. Okay, so for Monday, we'll start out with the 2 teams. One of the teams will do the industry and the super tree. Okay, so probably the super tree and then the industry. And then we'll talk about Nokia, and we'll go through the 4 evaluations, right? And then once we have a better understanding of that industry in class, we'll probably start doing another one of the telco suppliers. Okay, just learning about a brand new industry. And as I said, next week we'll probably spend a lot of time doing this, which is going to be our final dry run before your projects. So essentially, here's the key. With the model that you're doing this assignment on, this is the final model for your group projects. Okay, so what you're doing for Nokia is the same model because it now includes the sanity checks that we talked about to help you use the multiples as you go back and do your valuations. Okay, so as you're doing your group projects, use the same models, same methods, same practice for using the assumptions. Okay, and so essentially next week is a little bit like a dry run. Okay, so you've already did your as is for your companies. As I said, very quickly you can start putting your data into this model, same model, we just made these enhancements, and basically iterate again. And now you're getting closer to the final valuations. All right, questions about any of this? Okay, great. See everybody on Monday.